Africa is where it's at. This is Paul Harris for Kitco Mining, and joining me today to talk about gold mining in Africa is none other than Peter Marrone, Executive Chair and CEO of Allied Gold. Peter, welcome back to Kitco.
I'm happy to be here. Thank you, Paul, for having me on your show.
Really looking forward to this conversation, Peter. I know we tried to touch base earlier a few weeks ago. We couldn't manage it, but it's well worth the wait. You gave a fascinating presentation early this month about mining in Africa, and I recommend to our viewers that they go to Allied Gold website to download that. A lot of great data points there. Where do we start? Let's start with this. Why do African gold miners trade at such a steep discount compared to gold miners in other jurisdictions, do you think?
Well, I'd like to answer that question by asking why should they trade at a discount? So we talk about geopolitics, and it seems as if the reference point is always about geopolitics, and is one place more or less stable than another. There are more than 50 countries in Africa. Africa is the continent, not dissimilar to Asia, North America, South America. There are countries, and some countries are geopolitically perhaps more stable than others, but the starting point should be geopolitics, but not the ending point. The ending point has to be, how do you get returns and high quality returns? So if you're in a jurisdiction that has geopolitically more stability, perhaps a democratic place, let's pick Canada as an example, since I'm a Canadian by nationality. It's great to say that the geopolitics of the country is more stable than other places, but we're in business, and we're in business of mining. And so what's relevant to us is, how do we deliver returns from that which we do? And part of the return equation goes to, how long does it take for permitting? So I would argue that geopolitics is an input into the return calculus, but it is not the determinative point. There are others. And the timing for permitting is an example of that. There are occasions and situations in Canada where permitting could be infinite. You just don't know how long it would take, but it's certainly going to take a lot longer than it does in many of the countries in Africa, certainly the countries in which we operate, and we are permitted in those countries for our projects and for our mines. And I think that that's a distinction that has to be made. So I think it's about returns. Returns have other parts to it as well, Paul, which is the quality of the people who operate in the country, the mineral endowment. Part of the return calculus, as I mentioned a few moments ago, goes to, do we have an ability to mine? What's the grade of the mine? How quickly can we process? The level of competency of the people, and the ability, based on the geological endowment, the ability to extend mine life. And if I put all of that in, there are very, very, very few places in the world, indeed I'd say there are no places in the world, that deliver the types of returns that one can get in Africa. To your point, why should they be why do they trade at the discount? They shouldn't. And that's the way that we should be looking at this. If a place delivers a better return than another, then it should be valued better than the place that delivers a lower return. Geopolitics is just a part of that equation.
It does seem that things seem to happen a lot more quickly in Africa. And touching on your point that Africa is a continent of more than 50 countries, do you think part of the issue is that people look at Africa and just see, let's say, a homogeneous mass and don't see the individual countries there?
Yeah, so I think we have to, I hope I can say it this way, we have to get rid of a systemic colonial bias that exists to certain places in the world. We as North Americans, as Europeans, as the developing part of the world, which is where a lot of the investment dollars are, we have to recognize that there is history, but we can't treat every country as the same, and we can't treat every culture as the same. There will be cultural differences and nuances, and there will be differences and nuances even inside a particular country. That's not dissimilar to Canada, the United States, England, other parts of Europe, Australia. So we need to be sensitive to that. And I think if one demonstrates that sensitivity, you're well down the path of being able to get the social license to operate in these jurisdictions. Do investors have a tendency of painting a broad brush and saying this is the way that we should be looking at it because it is Africa, it is South America, It is the developing part of the world. I think there's some truth to that, but I think we have to put that behind us. I think we have to look at it on a country by country basis, on a region by region basis, and come back full circle. We have to look at where are the returns. Where is the ability to find more ounces with least amount of dollars that needs to be spent to find those ounces, to develop them, and then to bring them into production to generate cash flow.
As I mentioned, there are a lot of really good data points in your presentation, Peter, and one of those touches on license to operate, which you just mentioned. You said in Africa, or many countries in Africa, the model there, which eases this, is the fact that it typically includes direct ownership and royalties for the state, the host nation, ranging from, let's say, 10% to 20%, which you said is a superior approach, presumably compared to some of the regimes you see in Latin America, North America, and perhaps elsewhere. Why do you think that's a superior approach?
Well, there's an element of alignment. If the state owns 10%, 9%, 11%, as much as 20% of an operation, of the cash flows from that operation, I think there's an element of alignment that can't be overlooked. They have a vested interest in determining the profitability of that operation and the longevity of that operation. And that's really what I was driving at, which is that it is a model. Admittedly, all models need to be fit for purpose. Does it work in one place versus another? That needs to be tested. Perhaps in the developed parts of the world, that is not as important. But I think in the developing parts of the world, certainly in these countries in Africa, to be able to say that there's a direct ownership interest, I think provides greater assurance to me as an executive and as an investor and to other investors that we will maintain that social license to operate.
In your previous company, Peter, you had investments in Brazil, in Argentina, Chile. That kind of model that you just outlined, the Africa model, doesn't really exist in Latin America. And surprise, surprise, or maybe the two aren't correlated, companies are having an increasingly hard time getting license to operate, social license to operate in Latin America. Is it a region where you think the Africa model could or should be developed? And if so, why aren't other companies doing this?
Well, I think I'm comfortable saying to you that it works in countries in Africa. Perhaps it works in most, if not all, of the countries in Africa. I would have to better assess how it could work and whether or not it can work in other countries, in other developing countries, including in South America. But I can't see a reason why it would not work. And as I said, I think it creates a parity. I think it creates a certainty. Royalties and taxes and the like, there's an element of obscurity to it. How much is it? It goes into government coffers. If you're a public company that is producing from a mine, and 10%, as an example, of the cash flows go to the state, well, it's obvious for anyone to see that can look at a public record what the cash flows were, and it's obvious for anyone to see then what the cash flow contribution that goes to the state would and should be. So it seems to me that it's a more transparent model that can be made to work in other jurisdictions, but it would require a little bit more work on what I said before about the cultural sensitivities and nuances.
Well, I suspect this kind of model is going to become more prevalent in Latin America to address some of the issues we've been talking about. Now, there are several major gold companies actively producing gold in Africa: B2Gold, Goldfields, Anglo Gold Ashanti, Barrick Gold, Endeavour Mining, to name but just some. But you said Africa really lacks a true champion, and that is what you're directing Allied Gold to be. Many of the other companies I mentioned, they have producing assets in Africa, but not just in Africa. Allied Gold, however, is just focused on Africa. Why do you think Africa really needs a continental champion?
Well, there are so many opportunities on the continent in the different countries, and there are so many, perhaps disproportionate number of producing mines that are single asset, in single asset companies. And so it seems to me that in a world where everything has gotten bigger, let's take for a moment the assumption that we're always going to check the box that better is always required. You always want to have quality. But in the context of having quality, bigger is more important today than it has been in the past. And so my view is that to be a single asset company, to be producing 100,000, 150,000 ounces per year, I think is interesting, but that's not where the world is at. The world is at bigger is better, consolidation. There's more to it than that, which is the opportunities that are available to others. We overlook that in mining companies, it's not just about the assets, so the resources in the ground and how we mine them, but it's also about the people that are doing it. It's a people business as much as anything else. And to be able to say that we have multiple operations, we have diversification of operations, jurisdictional diversification, type of asset diversification, size and scale, I think also allows us to be able to attract better talent and to move that talent to different places. I think there's better opportunity for promotion. We certainly saw that in Yamana. You're familiar with what we did there. And we certainly saw that as we became bigger with more diversity in our operations and in different countries, we're actually in a better position to attract, to retain, and then to promote, internally promote quality talent. And again, we're now almost at the first anniversary of when I was first introduced to these assets and conducted site due diligence. It seems to me that there are impressive, high quality mining operators, engineers, geologists, metallurgists that operate in these countries in Africa that are from those countries in Africa. And that's what we're trying to encourage. We try to shy away from expats, similar to what we did at Yamana. We prefer to rely on the high quality talent that exists in a jurisdiction, preferably close to where the mine is. And what diversification in size and scale allows us to be able to do is not only attract a different sort of international investor, but also allows us to be able to attract considerably more talent inside the organization and to retain that talent.
Now, Peter, you're replaying, if you like, much of the Yamana playbook in terms of how you are looking to grow Allied Gold up to that producer of scale. You eventually got Yamana to about 1 million ounces a year of annual production. Last year, you're well on the way with Allied. Last year, production of 343,000 ounces, 817. Operations in Côte d'Ivoire, Mali, and Ethiopia. Expansions on underway or planned to be underway at Kurmuk, Diba, and Sodala. You're guiding for up to 400,000 ounces of production this year and much more to come. So what is the sort of growth arc that you see for Allied Gold?
So let me begin by answering in this way. If someone had presented to me 3 producing mines or complex in Côte d'Ivoire between Bonikro and Agbao, and in Mali, the Sadiola mine, with a production platform of roughly 350 to 400,000 ounces per year, frankly, that alone would probably have been attractive to me. But there was something else, and that something else was the following. This company, these assets, have impressive production growth. That roughly 400,000 ounces doubles to more than 800,000 ounces with step-ups in the middle. So we go from 343,000 ounces last year to just about 400,000 ounces this year, another step up next year, between 400 and 430,000 ounces, a big step up in 2026 when our mine in Ethiopia comes online. So at that point, then, we will have a significant production platform of 600,000 ounces. That will then further increase by 2029 to more than 800,000 ounces. So roughly 100% production growth. What was attractive to me was not only that. What was attractive was that it's the contribution again to that bottom line. If one can get a 100% production growth, but all those new ounces are coming in not only at lower cost than what we're currently operating at, but at lower cost than what's in industry, the average in the industry, that means that the margins expand, and they expand in our case pretty dramatically. So we're getting these new ounces coming in at below, in one case, $950 per ounce, and in the other, in the case of Sadiola's expansion, at less than $1,000 per ounce all-in sustaining costs. That means then that the contribution to EBITDA and to cash flow, what I'm calling the bottom line, is a multiple of that 100%, somewhere in the range of 300% plus. That further increases, of course, where gold price is, because this analysis was done with a $1,900, $1,950 gold price, and we're now a couple of $100 above that. So that was very attractive to me. Also attractive to me was the fact that there was gold everywhere. And so it wasn't that Sadiola's expansion will take that mine out for 2 decades. I think we're going to be there for longer than that. It wasn't that Bonikro and Agbaou had mine lives of about 5 years, because we've already said that strategically we expect this to be in excess of 10 years. And we've already discovered the areas where we're bringing that into inventory. There's an area north of Bonikro that has gone from a couple of 100,000 ounces at the beginning of last year to almost 1 million ounces at the end of last year. And that number will continue to increase this year. That will provide feed and contribution to the Bonikro mine and extend its mine life quite dramatically. And of course, Kurmuk in Ethiopia, we've started with 2.6 million ounces of proven and probable reserves. That carries us with a mine life of about 9 to 10 years. But we've said that there are areas that we're already exploring, we're already getting drilling results. We'll provide an update within the course of the next month to 6 weeks on some of those. And what we intend to be able to demonstrate is we've got at least 5 million ounces of inventory. So getting from 2.6 million ounces to 5 million ounces of inventory is quite significant. And in my view, a 5 million ounce deposit with 275,000 ounces per year over at least a 15-year mine life, that all-in sustaining costs of below $950 per ounce, that's world class. That's the type of cash flow that any company would want to have.
Excellent. Well, I want to change track now, Peter. You've been involved through your career in a lot of M&A activity, buying and selling. I always like talking to you about this. We've seen some good deals starting to happen, such as Alamos Gold buying Argent Gold announced today, and earlier this week, Kitco Mining and Gold Source. Are the floodgates now starting to open on gold M&A?
Are they starting to open? Well, I think I know of one, not the other. Well, it seems to me that that's very strategic. I think that my impression is a very smart transaction. There are synergies that can come from that acquisition. And so are smart transactions beginning to occur? I think the answer is yes, but I think there are more smart transactions. Look, our entire industry, the market capitalization of the entire industry is roughly $350 billion. That is a fraction, literally a fraction, of the size of a company like one of the technology companies like Apple or Google or one of those. It probably represents the amount of cash balances that they have on their balance sheet. So it's a small industry. But there are thousands of companies in this industry, and at least scores of companies, more than multiples of handfuls of companies that are producing companies. And it seems to me that there are other opportunities where one can create value, significant value for investors by consolidating those. I hope it does open the floodgates. I would say that these were strategic transactions. Perhaps more will come, but time will tell.
Okay, well, let's perhaps bring it a little bit closer to home for you, Peter. You mentioned a moment ago that there's gold everywhere in Africa. Do you see consolidation opportunities in Africa for Allied Gold or for somebody else for that matter?
Now, I'm not going to give away the trade secrets, but I think it would be fair to say that we are looking at opportunities. We do need to demonstrate, as we have been doing. Remember, we've only taken this company public as of early to mid-September last year. We do need to demonstrate that we can optimize operations. We need to demonstrate that optimization includes increasing the number of ounces of production and also improving the costs. We are beginning to demonstrate that. We want to get a bit more line of sight on the growth, including the asset, the Kurmuk mine in Ethiopia. But as we get closer to that, I think it becomes an imperative for us to look at what's outside of the company that can be brought into the company and where we can create further value. Part of that also is that our share price should begin to perform as we begin to demonstrate that we're delivering on the goods inside the company. And as that occurs, then I think that we will be very comfortable with the idea of looking at corporate transactions and business combinations outside of the company. It was one of the things that we did at Yamana well. When we look at what Yamana was at the beginning of its history to the end, the assets that were there at the end of the cycle of the company when we sold it, those assets were not there at the beginning. And so we looked at it from the lens of how can we optimize and improve, but then optimizing and improving also includes a portfolio. How can we improve the portfolio by bringing something in, and perhaps then something that is in the portfolio that is no longer fit for purpose, we can then sell. What I find interesting about this company, unlike Yamana, is that I'm seeing nothing presently that is inside the portfolio that would not be fit for purpose, even when we are 1.5 million, or 2 million ounces per year. Sadiola is world-class, with more than 300,000 ounces of production, 2 decades of mine life, and with an all-in sustaining cost below 1,000, as I mentioned. Kurmuk, as I described before, with its mine life and almost 300,000 ounces of production at below $950 all-in sustaining costs. Bonikro and Agbaou are small mines, but they're 17 kilometers apart, Paul, and that's the interesting part. Historically, they were owned by 2 separate companies, each producing roughly 90 to 110,000 ounces per year from those mines. 17 kilometers apart, it makes sense to have it in one company, an access road between the two. Now we've consolidated that entire area. And as a complex, at 180 to 200,000 ounces per year, all-in sustaining costs that we expect to be below industry average, at roughly $12.50 per ounce. Not as good as the others, but still very decent. So 200,000 ounces per year with that, a mine life of more than 10 years, that becomes very interesting. Where we'd have just one at 90,000 ounces per year, perhaps not so interesting. Turn the portfolio over, I guess. But what I see in the portfolio today with a complex at Côte d'Ivoire, with Sadiola in Mali, and with our Kurmuk mine in development in Ethiopia, I can see us adding to what we have, but I see nothing that we would subtract from the portfolio.
Okay, Peter, as we're drawing to a close, let's just close on a strong note. What are the sort of 2 or 3 main catalysts for Allied Gold this year?
So expect, as I said, that there's gold everywhere. And we've also indicated that we have a $32 million exploration budget this year. That complements what we did last year. It's a bit of an increase over last year. But expect that we'll deliver an exploration update. We indicated on our Q4 conference call this morning that we expect that sometime in April. You should expect that we'll begin to demonstrate that Kurmuk will be that 5 million ounces, that very long mine life that I described before. I mentioned north of the Bonikro mine, that area called Ume, where we are seeing some very significant potential for that to increase mine life because of the increase in the inventory of ounces. It is north of the Bonikro mine, but we would truck it to Bonikro. And we expect one further thing, which is the oxide potential at Sadiola. We're talking about the future being fresh ore, the harder rock, with a new plant. Well, we can't overlook the fact that there is a plant there presently that processes more than 5 million tons per year and was designed for oxide. So we're looking at how we make new oxide discoveries, and we're getting a lot of that. The next, of course, is our Q1 results, which we expect, I believe it's May the 9th, May the 10th, in the first to second week of May. And then we'll continue to provide updates on our Kurmuk project. We want to be able to demonstrate that we are, look, we're in early 2024. It begins operations in the second quarter of 2026. But we've already taken some steps that accelerate the program, or at least assure that the program is assured for the second quarter of 2026. Hiring a mine contractor now so that we can begin early works and earthworks in particular, and doing some of the infrastructure. And then in addition to that, we already own the SAG mill. So some of the very long lead time items are already within our, in storage in our warehouses. So those are some of the messages that I hope to communicate. And finally, that given that we're producing 400,000 ounces per year, given that we're producing from 3 mines, the complex in Côte d'Ivoire and in Sadiola and Mali, and the growth that I described earlier in this conversation, it seems to me that there's some significant upside in share price. And I will be constantly pounding the table on that one over the course of the year, that the share price is low, and this is the opportunity to come in, and that opportunity will not last. And I saw this before, Paul, if I may say. We were, for quite some time in Yamana, we'd gone public at $1.20 per share, and for quite some time, we were stuck in that range of $1.20 to maybe $3 per share. And I remember one person saying something very interesting to me. When we became a $4 billion company and our share price had gone up dramatically, he approached me and he said, when did that happen? And how did I miss the opportunity? So part of what I'm communicating is don't miss the opportunity.
So wake up.
Yeah.
Okay, that's great, Peter. Look forward to catching up with you later on this year to find out how things are going. Thank you very much for joining us today.
Thank you very much.
And this is Paul Harris for Kitco Mining. And if you like what you see, don't forget to subscribe.